Most investors fail to beat the market averages, but index funds can help level the playing field. Index funds are a type of investment that tracks a group of assets. They work by holding a small piece of every asset. This helps reduce risk by spreading it out. For example, a fund might hold a tiny piece of every company. It does this to give a broad view of the market. By doing so, it earns the average return of all the assets. Diversification is key to a healthy investment. It protects by spreading risk across many areas. Imagine putting all your money in one store. If the store fails, you lose everything. By spreading it across many stores, you reduce the chance of big losses. This way, if one store fails, the others can help balance it out. Low-cost investing with index funds saves money over time. It works by reducing fees that managers charge. For instance, a small fee of 1% per year adds up. Over many years, this can be a lot of money. By using index funds, investors keep more of their earnings. This helps their money grow faster and stronger. Consistent investing creates a snowball effect over time. Money grows as interest earns interest. For example, a person saves $100 per month. This steady habit builds wealth slowly but surely. As years pass, the total amount grows significantly. Patient investors see their money multiply over several decades. When choosing an index fund, consider your personal goals and timeline. Think about when you need the money, like for a big purchase. Look for a fund that tracks a specific market, such as the entire stock market. This helps you match your investments to your needs, like saving for a down payment. For example, a young person might choose a fund with a mix of stocks and bonds. By doing this, they can balance risk and potential returns over many years. Long-term investing strategies help reduce emotional decisions. Fear and greed can lead to poor choices. For instance, a person might sell during a market downturn. This can result in missing a potential rebound. By having a long-term plan, investors can ride out volatility. A steady approach helps them stay focused on their goals. To manage risk with index fund portfolios, diversify across asset classes. This means spreading investments over different types. For example, combining stock and bond funds reduces overall risk. By doing so, a decline in one type can be offset by gains in another. This strategy helps protect against large losses over short periods. It also allows investors to take advantage of growth opportunities in various markets. Tax efficiency matters in index fund investing because it saves money. Investors can reduce tax bills by holding funds longer. For instance, a person who holds a fund for 5 years pays less tax. This is because long-term capital gains are often taxed at lower rates. By minimizing trades, investors can also reduce tax liabilities. A simple example is buying and holding a fund instead of frequently buying and selling. Avoiding common mistakes in index fund investing is crucial. Overconfidence can lead to poor decisions. For example, trying to time the market often fails. Emotions like fear and greed can cloud judgment. A calm approach helps investors make rational choices. By setting clear goals, investors can avoid impulsive decisions. To create a balanced portfolio with index funds, diversify across asset classes. This means spreading investments over different types of funds. For example, a mix of stock and bond funds helps reduce risk. By doing so, investors can ride out market ups and downs more smoothly. A balanced portfolio also helps investors avoid overexposure to one sector. By allocating funds thoughtfully, investors can enjoy more stable returns over time. Start building your long-term wealth with index funds today.